Hi, and welcome to your weekly macro roundup. We talk macro, trying to make sense of markets that really don't. Well, you know what? On months bond prices are up, they totally make sense. I mean, totally. And answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because I've got a great episode lined up for you. I want to spend some time really rehashing into how QE works, but I'm going to give you a different view, perhaps an easier to digest view, because really my macro theme is like on the edge of playing out. I mean, it's so cool to see this in real time start to happen. And I want to make sure that you're completely on board and understand, how this quantitative easing works. So I'm going to give you a completely different example than I've used before, and I hope it makes sense. And we're going to take that example and look at the data, with what's going on with the Fed balance sheet and all that stuff, and see that it really does make a lot of sense why quantitative easing leads to lower interest rates. And if interest rates eventually go down more, well, that leads to lower stock prices, although you really wouldn't get that. Now, one thing I do find interesting in the news, well, it was news last night with the tech earnings, is you've got Congress busy, trying to figure out how to regulate and potentially even down the road split up the big tech companies because they're, getting all this money. And yet, isn't it pretty obvious that a lot of the stimulus money went to those same companies? I mean, does Congress even realize that, giving people money is flowing right into these companies? And why is that a structural problem? Well, in the real economy, you can't have an economy just full of large corporations. I'm buildings. I'm kind of looking at buildings. You just can't have an economy made up of just a small number of large corporations, because in order for a large corporation to exist, and I don't know the number, you need so many, say, X number of mid-sized businesses. And for those mid-sized businesses to exist, you need so many, Y or small, or a number of Y's. God, I'm confusing myself. A number of small businesses. How many, I don't know. And then out of that, you need so many people who are self-employed, and you need so many consumers. So what's happening is, inadvertently through the stimulus, Congress is really pumping money into 5 large U.S. companies while everything else around them is crumbling. And yet investors think that these 5 companies somehow will stand through the test of time and they will get through this, without realizing that if all these other businesses are failing to some level, or their size is shrinking, that eventually that will flow over into those large companies. Now, at the end of the video, there's going to be an adjustment to our schedule next week, so I want to go over that. I also want to address my comment from the last video about potentially ending the show at some point, but I'll do that at the end for those of you who aren't really that interested in that. I wanted to give you kind of what I was thinking, why I'm thinking, and maybe how you could help. And I certainly would appreciate that. So let's kind of jump right into the economic data, and then let's come back and talk about quantitative easing, and then kind of move through the data as we normally do. So real quick, we'll just go back to Wednesday evening. So what do we have? Anything interesting here? Export prices, and that was our second quarter. Retail sales out of Japan improved from minus 12.5% in May to minus 1.2% in June. So even though the economy in Japan is just in terrible shape, it's nice to see Japanese consumers were out spending some money. So on a year-over-year basis, minus 1.2 isn't that bad compared to minus 12.5%. Moving into Thursday, I think we've got the Eurozone CPI data coming up, so we'll look at that. German CPI. Okay, U.S. Thursday, jobless claims. Initial jobless claims slightly beat expectations of 1.434 million. People think you can have an economic recovery with 1.4 million people filing unemployment claims? Yeah, I don't think so. The continuing claims edged higher to a little over 17 million. I don't know what the pandemic unemployment assistance number was, so I'll presume we're still somewhere in the 31 to 32 million people receiving unemployment. So this continuing jobless claims number, for those of you who are new to the show, does not include the PUA numbers at all. In fact, those numbers are somewhat hard to find if you go looking for them. Moving on to personal consumption expenditure prices, where these are all second quarter. We had that today. I'm not too concerned about the quarter-over-quarter stuff. We know it was going to be ugly in the second quarter. Moving on to South Korea industrial production on a year-over-year basis in June improved from minus 9.6 to minus 0.5. So that's showing signs of recovery in industrial production out of South Korea. Retail sales slowed from it's a month over month. So it went from 4.6 to 3.4, so that's pretty good. Let's see what else we have here. China PMI data. So let's look at the composite PMI. Now at 54.1, this tells you there's a slight expansion. So anything over 50 is an expansion, and the further it's over 50 is the more expansionary it is. So let's look at the composite, which is a blend of manufacturing and services, or maybe not. There we go. And coming back to March, it cratered at 28.9. So effectively saying the economy was shut down. Now everyone looks and says, look at the graph. It's right back to where it was. The Chinese economy is back to normal. Not how you read this. The way you read this is the following months was 53. So slight expansion from dead. Next month, slight expansion from slightly better than dead. And next month, slight expansion. You get the idea. It's a slight expansion over the following months from dead. Is it back to normal? No. But you can't determine that by the PMI numbers alone, unfortunately. Let's move into the Friday data. And somewhere in here, they've got the Eurozone CPI preliminary for July, showing that it may improve from 0.3 to 0.4. Not much inflation going on here. And we learned from Fed Chair Powell's recent testimony that the coronavirus is very deflationary. In fact, if it wasn't for all this government stimulus around the world, we would be seeing some massive deflationary prints, and we're yet to see those. I still think they're coming. Core CPI on a year-over-year basis, excluding food and energy, on a preliminary basis out of the Eurozone, up to 1.2%. Let's move into the U.S. data. Personal consumption expenditure price index. So price would lead to an increase in consumer prices. So price index on a year-over-year basis improved from 0.5 to 0.8. So higher prices fed into the system, excluding food and energy on a year-over-year basis. They slowed slightly from 1 to 0.9%. And looking at personal incomes on a month-over-month, went from minus 4.4 to minus 1.1. So incomes are falling. But look at spending, an 8.5% the last month, 5.6% in June. So that means people are out spending money and they're not earning. So they're spending more money than they're earning. Inflation adjusted consumption was at 5.2% for June. So that's pretty interesting. The Chicago PMI, this is really interesting, came in at 51.9, but look at the prior month, 36.6. So the initial things I saw, the headline number said, oh, the Chicago PMI is back to normal. No, this is a very, very slight expansion over a very bad number. I mean, it's showing there's no improvement. It's saying things marginally at the very smallest level improved over last month. It does not mean, hey, everything's normal. In fact, it means things are pretty bad in the Chicagoland area because it went from 32.3 to 36.6. So at its deepest contraction, it contracted again, and then it slightly improved from that. Very, very slightly improved. So the way you read this is things in the Chicago Purchasing Managers Index, which is the Chicago region, are bad. All right, let's talk about QE and how my thesis is playing out. Because remember I said this is just going to be as it was in GFC, where the Fed is going to literally kind of nuke the whole economy by doing QE. And I want to give you another example because there's lots of videos. If you can do the show, you can go back and dig through the headlines and find them. But let's just use an example. Let's say you go to the grocery store, right? And you turn down an aisle and all you see are cans of, say, tomato soup or whatever soup you like, but just make them all the same. So you see just the whole length of that aisle, as far as you can see, floor to ceiling, tomato soup. And on the top of the shelf, so I guess not floor to ceiling, floor to the top of the shelf, is tomato soup cans. And on top of the shelf, there's just boxes and boxes and boxes and boxes of soup. And then there's those aisle stands and all over the aisle of more soup. Now, as a consumer, would you expect tomato soup prices that day at the store to be higher or lower than normal? Well, you naturally go like, man, there's way oversupply, or clearly there's some demand coming that I'm not aware of. Maybe there's a lot of grilled cheese sandwiches coming and people are demanding tomato soup. So you would think as a consumer, prices would fall. Now, a lot of people think that if you substitute tomato soup cans for Treasury yield or Treasury bonds, that too much supply would lead to higher interest rates, okay? Now, the Fed is kind of aware that perhaps there is too much supply in the market because there needs to be a balance between government debt and the private sector, and it's completely out of whack right now. There's way too much debt. So what does the Fed do when it does quantitative easing in the example? Well, think of the Fed coming down the aisle with a shopping cart and literally just taking rows and rows of soup cans and putting in the shopping cart and taking it off the shelf. So let's say they reduce that total supply down to half. Now, the investors and analysts and other quote-unquote experts, people on bubble vision, they think when the Fed takes a can off the shelf, they leave money there. They think that money is being replaced. It's not that case at all. It's almost like an IOU. So the Fed takes the cans off the shelf. So they're reducing supply. This is very important to understand. They're reducing the supply of tomato soup. And in exchange to the store, they're saying, look, we're going to put some money in an account over here. We're going to give you effectively an IOU that says, if we don't return the soup cans someday, you get this money. But as long as we have the soup cans for an infinite future, you can't touch that money. So instead of money being placed on the shelf, there's little IOUs to the store that says this is equivalent to a soup can, but no one can buy it, no one can touch it, it just is there. Okay? So when the Fed buys these treasuries and mortgage-backed securities, they don't give the banks money, they give the banks a reserve account that the banks cannot touch. They can't touch it. They can look at it, they can visit it, but they cannot withdraw it. So what the Fed is doing is they're reducing the supply of soup cans on the shelf. Now, as we reduce the supply of tomato soup from a consumption standpoint, so now you're a consumer, you turn down the tomato soup aisles, we'll call it, and you just notice that all of a sudden that the amount of soup is just shrinking. What do you think is going to happen with the price? Well, the price might go up because when supply goes down, price goes up. Now let's put this into a pandemic situation because we've all just been through this. And in a lot of cases still going through it, but not from a specifically a grocery store perspective. So let's say the Feds come along and every day they're coming along with their cart, taking some more cans off, taking some more cans off. Now there is new supply coming, so as the delivery company comes and they put them on the shelf, there are some people that come in and buy it all the time, and these are foreign and domestic investors. They buy them at the auction, and what's left on the shelf, then the Fed has to buy from that. The problem right now is the Fed is buying more than the new supply, so the amount of shelf space of soup cans is shrinking. Now, at some point, when the amount of soup cans is low enough, what do you think will happen to the price of soup? It will go up. Investors won't know why. All they'll notice is, man, the other a couple weeks ago there was just soup cans coming out of the store's doors, and now there's only one little section, and so the demand and price for soup will go up. That's why you see bond prices going up. Now, what happens when you get a shortage? So a pandemic comes, people run to the store. And do you remember what people were doing in the store? Because we all were kind of guilty of this. You go down the aisle and like, I don't normally like lima beans. In fact, I really don't like them at all, but that's like the only can left. And you go like, oh, there's 2 cans. I'll take them. Now, how many people were excited about that? I don't know, but people were buying stuff they normally didn't eat. And they were paying a price, maybe above market price, because it was the only thing left. So now imagine there's a pandemic in the economy, bigger than there is now. And people go to the store and they're reaching for those tomato soup cans, and there's only a few left. And they start grabbing them as the Fed comes in and takes all the rest of them off the market because it thinks that we need to reduce supply. What happens to the price of soup at that point? Straight up. That's what happens with Treasury bonds. Just take that whole example, swap out soup with treasuries. That's why, you hear people, don't fight the Fed, and they run and buy stocks. No, you should buy what the Fed is buying, because they're going to clean out the inventory. And right now we're seeing them clean down the inventory, because when we look at the auction data we don't talk about it always on the show, but I look at any of the 2, 5, 7, 10, 20 and 30-year auctions, and I'm looking to see how much goes to the dealers, or in this case, how many new soup cans are getting on the shelf, and how is that relative to what the Fed is buying. And right now, the Fed is buying more than the new supply that is hitting the market, meaning the banks are going to need more bonds. How are they going to get them? Well, they're going to go to the dealers and say, hey, we need to get more bonds. And dealers got to go out to the market, and they're raising prices to get people to sell. And that's what's so interesting here. I hope that helps make a bit more sense of how this whole QE picture works. So when we look at what's going on, and we go to the Fed H.4.1, and this shows what the Fed currently owns, the Fed balance sheet. Now, notably, the rate of decrease is starting to bottom, which is good, because we should see the dollar reverse, as there's a relationship between the Fed's balance sheet and the dollar, and I am expecting the Fed balance sheet to rise as along with the dollar. But let's look at the U.S. Treasury securities holdings here of the Fed. And we've noted for the past couple of weeks, and probably a little longer, they haven't been buying any Treasury bills. And why haven't they been buying them? It's real simple. The banks needed them as collateral. Why would the banks want T-bills? Because they're highly illiquid. Look, you buy one, you can sell it on the market pretty much any time. There's a huge amount of buyers for them. And if you can't find a buyer, well, wait 12 months or less, because the thing will mature and you get your money back. It's not like, hey, I got to wait, 29 years and 6 months. No, you may be, depending on your portfolio of T-bills, you may have some maturing next week. And so banks want T-bills. And so they pressured the Fed to say, hey, look, you can do all the QE you want, but save us the T-bills. And so the Fed started doing that. Look at what they're doing. They're buying notes and bonds and TIPS, so Treasury inflation protected securities or inflation index. All of their purchases is mostly in notes and bonds. Now think about this from the store perspective. The bills are spoken for. The market wants them. So when the economy rolls over again, which it will do, and the Fed is forced to buy more or engage in more QE, because what else can they do? They can't go anything below zero, and so the only thing left for them to do is more QE. But the banks already stood up and said, hey, Fed, you leave those bills to us. We want them. You notes and bonds, you can do whatever you want with. We want the bills. But are they really setting the Fed up for a big payday for the smart money? Because the smart money's been buying bonds and notes for years. Back when everyone almost 4 years ago, post-election, when the retail public was going crazy about stocks, the smart money's been buying bonds like crazy. And they want to get paid. And how are they going to get paid? Because they eventually know the Fed is going to get boxed into doing more QE. And we know they're going to, because the economy is not turning around, despite all the government transfers. And when the Fed does that QE, where are they going to buy it? Notes and bonds. And what does that mean for interest rates on notes and bonds? Headed towards zero, possibly negative, because the banks are effectively telling them, no bills, you buy that stuff. Fed says, fine, we'll buy that stuff. And we can look at the auctions, and we can look. Just recently, they had a 0 to 2.25-year Treasury coupon auction. Do you know how many 0 to 12-month coupon they bought? Zero. They bought $12.825 billion of everything over 1 year maturity. So coming up next week, we've got a 7.5 to 30-year TIP auction, and TIPs are only issued in 5, 10, and 30 year. So this will be a 10 and 30 year. And I don't know why, even though these are a very small amount, 1.2 billion, it does actually help the long end of the bond curve. And on Tuesday, they're going to buy 4.5 to 7 year maturities. On Wednesday, they're buying the long bond, 30 years only. On Thursday, they're going to buy 7 to 20, which means they're buying 10 and 20 year issues. So they're fairly long on the curve. Friday, they're back on short-term TIPS, 1 to 7.5 years. So this is going to be 5-year maturity and 10-year original issues that have 7.5 years or less, and then back again on the following Monday with $1.75 billion in long bond. The Fed's eating up the long end of the curve and everything in the middle. And when they come back at that next round of QE, that's why I'm so excited about the bond market, because when you look at the charts of the bond market, it's telling you bonds are about to literally go suborbital, and they're going to drag the dollar with it. We looked at that, over the last couple of weeks. We've looked at why the dollar is likely headed higher, why it follows bond prices higher. And when the two go together, you get a double tightening in financial conditions, and then everything else blows apart. So I hope the soup can explanation makes some sense. And when we get to the charts in a little bit, and we look at the credit data here momentarily, the reason for the credit data is we're looking to see if there's a demand from the market at current rates. And we know for the last several weeks, there's none. So people say, well, your rates have to go up. Look, rates can't go up when there's no demand for rates now. It's like saying, hey, we've got an aisle at the store full of lending for people and no one's shopping. So hey, well, why don't we raise rates? That will certainly bring more people into the store. No, not how it works. So we need to look at the credit data, and that should also validate why bond prices are headed higher. So let's go to the assets and liabilities of commercial banks in the U.S. This is the H.8 data, comes out on Fridays around 1:15 Pacific, and this is one of my favorite things to look at. And we see securities and bank credit increased by about $9 billion. What's interesting to me is the banks have been shedding mortgage-backed securities. At one point, they had 1.071 billion, and now they're down. Oh wait, did I say shedding? I meant they're increasing up to just this other week here. I thought there was a 1 there. Got to deal with those new contacts. So here we see they dropped 10 billion over last week. They're down 14 billion here from their peak. But what's interesting, yields are falling despite the banks dropping off some of their Treasury securities. So it's making me wonder if the Fed is just overdoing it, and the banks have no choice. They've got to sell to the Fed. But look at what they are buying, massive amounts of mortgage-backed securities. Now, this is great for the long end of the curve, because where are most mortgages issued? 30 years. So the Fed's buying up the long end of the curve. And I mean, the Fed's buying it, but so are the banks. And why would the banks buy all these mortgage-backed securities? Do you think it's because they want them? No, it's because they think the Fed's going to have to buy them. So look at this. They increased by 16 billion last week, and that is substantial. That's why you're seeing long rates headed lower. Let's take a look. Loans and leases at all commercial banks up 2 billion. So we're finally seeing some flatlining in bank credit. Let's take a look at commercial industrial loans up 2 billion. Real estate loans up 5 billion. Not much, but despite all of the talk about new home sales, existing home sales, and demand for mortgages, there's not a lot of growth in the real estate credit market here. In fact, are we above the peak? Yeah, we're just slightly above the peak by 2 billion. Not much going on there. Commercial real estate up 4 billion. How about the consumer? Down 1 billion. And look at their credit cards, down $1.5 billion. So consumers aren't spending here. They're refining, clearly not cashing out and spending money, and that is not good. It's telling you there are structural problems in the economy. So when you look at the H.8 and you say, well, interest rates have to go up, there's no lending growth. None. So how can there be higher interest rates if people don't want to borrow at these rates? That doesn't make any sense. It's a supply and demand issue. You want to see higher rates? You better see these numbers skyrocketing up, because it's telling you there's demand for people to borrow at these rates. When there is no demand or very low demand, then rates will go down until they find demand. My view is I think there isn't going to be a whole lot of demand until we get to zero, and even then, I don't think there's going to be a massive amount of demand there. There will be, but I don't think it lasts that long. I mean, think about it. Who are the big players in terms of generational or cohorts in the economy? You got the boomers, the large, not quite the largest compared to the millennials, but the largest consumer group out there right now. And what are they doing? Are they taking on new debt? No, as a group, they're paying it off. And then you have the millennials, the largest, and they're already loaded down with debt. So how are they going to take on more? more debt. They've got to offset what the boomers are going down. So the boomers are draining off their debt. The millennials have to balance that by taking on new debt, and then they have to take on even more. This is very deflationary. So the market is telling us that rates are too high, and I'm saying even if rates go down to zero, that may not be enough. It may work for a short period, but there may not be enough demand there. I mean, there's still 30-some million people unemployed. I mean, how's that going to turn into more lending demand if the economy doesn't get back to work and turn around very quickly? All right, on to the PowerPoints. Where are they? There they are. M2 money supply is appearing to roll over a little bit on a year-over-year basis. 6-month rate of change, that is probably a typo. That's probably supposed to say 12.6% or something like that. 3-month rate of change, there's no way it's 1.6. That number is not correct. Could be 16 point something, but well, whatever. 3-month rate of change is at 5% and falling. In my view here, on the money supply is we've seen people save because they've had extra income. And now, as of this week, a lot of people don't have extra income. And until Congress does something, and who knows how soon they will, but every week that passes, I expect every week that they don't pass something, let me change my wording there, I'm expecting the M2 to go down because people are going to have to start pulling money out of savings to supplement and pay their bills. And I think starting next month, because when will we have our first deferment? It was March, April, May, June, July, August. So in September, guess what starts to come back? Bills. You know, it doesn't mean they're going to get it all lump sum at once, but people are going to have to start paying on their mortgage and cars and credit cards and whatever stuff's in deferment because those were at 6 months. You know, they're not going to be indefinite. Yeah, just pay when you're ready. Yeah, no, I don't think that's how it works. All right, back to the PowerPoint. Monetary base is sliding because the Fed's balance sheet has been falling, so I expect this to start to bottom out pretty soon. We do know there's been a fairly decent relationship between the monetary base and the dollar. There's a reason the dollar is going down. We've been through that here recently. The money multiplier is up, but what's interesting, the money multiplier is indicating inflation is coming only because the M2 is rising. And I've got to clear some of these things off my screen because I'm alt-tabbing into the wrong place. And the M2 would normally be inflationary if all this saved money goes out and is spent in the real economy on discretionary goods and services, specifically foreign produced goods and services. If it eventually goes back to pay debt or living expenses, it's not. So the money multiplier does not guarantee it's inflationary if it's rising. It just suggests it. My suggestion is that it at some point should start rolling over as money comes out of bank accounts to pay bills and living expenses and loans. Real estate loan growth down to 3.75% from a year ago. So we have record low mortgage rates and sub 4% growth in mortgage loans, and this is not good. I mean, we're normally up here in the 10+% on a year-over-year basis. 4%, sub 4% is very weak. And looking at the 6-month rate of change, is 1.14% and falling. This 3-month rate of change is virtually at zero. So you have record low interest rates, and on a rolling 90-day basis, we have no growth in lending. That does not tell you that rates are too high. I mean, it doesn't tell you they're too low. It tells you they're too high. So rates need to come down so these numbers can go up. Commercial industrial lending growth rate is down to just 20% from a year ago. It's rolling down. The 6-month rate of change actually ticked up slightly, but the 3-month rate of change is negative and headed lower, and that is synonymous with a recession. How about loans and leases at all commercial banks? Growth rate's down to 7.53% from this time last year. The 6-month rate of change is just over 5 and flat. The 3-month rate of change, consistent with a recession, is at negative 2.46 and falling. And wait for that mortgage number to start turning negative, and this thing's going to really start to accelerate lower. How about consumer loans, credit cards? We already saw that they didn't charge $1 billion, or they paid off $1.5 billion last week. The growth rate is down slightly to 7.97%, and you can see this is not what you want to see in a recovery at all. No way. All right, let's move into some charts and see what we've got going on there. And I mainly want to look at the bond market because, hey, this is somewhat the bonds show. But let's just take a quick look at the equity market. The S&P 500 has been following this rising trend line. It's now underneath it. Bulls are trying to get back over it to validate the trend. The NASDAQ did it make a new all-time high today? It did not, but people are chasing tech stocks higher at record valuations. Trust me, this never plays out long term. The Dow is pretty much stuck, going nowhere, sitting right at a resistance level that would indicate that it's going to head down and retest its support level here just under 24,000. Russell 2000, it's trying to get back above its rising trend line, not having much luck so far. And the volatility index, I'm really closely watching this 31 level. The market keeps trying to sell volatility to get stock prices up. At some point, volatility will spike higher, get over 31, and I think we're at risk for a massive unwind like we saw back in late February, early March this year. Energy stocks not looking too hot all of a sudden, and they're starting to break their rising trend line, which looks like a very clear topping pattern. Would suggest now that if XLE breaks 34, that it is going to revisit its all-time lows and likely go lower as we head into the fall. And there's less demand for crude and products in the fall and going into the winter, especially if we don't have a lot of air travel and other cruises and other things that people can do. How about financial stocks? They're teetering on the edge of breaking down from their rising trend line that looks very clearly like a topping pattern. As this goes, I expect yields to fall, and sure enough, we can see, look at the 30-year. It's in this supply zone, which is very interesting because we did see buyers come in here today and push yields up, and then they got sharply rejected. We'll look at that. But you can see buyers for 30 years, or sellers, for 30 years have been right between 1.2 and 1.25. And this is very clear going all the way back to March. So you've seen sellers, sellers right above this, sellers in here, still people selling. When these sellers are all flushed out, I don't think there's anything going to keep the 30-year from heading towards zero. Let's take a look at emerging markets real quick. It's still above its rising trend line. That could quickly change. Remember, most of EEM is, a big chunk of EEM is China. So let's take a look at TLT, and then we'll take a look at the dollar. Let's zoom into the 10-year history, or 10-day history, where, as I pointed out on Wednesday, we're in a consolidation pattern, and then sure enough, it broke out of that consolidation pattern yesterday in overnight trading and kind of was flattish during the day, and then in overnight trading, it got dumped back down right to support, traded right back up, and then in pre-markets today, it was sell, broke through support. And why did sellers try to get it through support? Because they were hoping to find other sellers that were in here, and then they found out there weren't. And let's zoom in, because right here, right at this point where you see it kind of zoom straight up, the Fed's QE auction literally starts right there at that point, and it only runs for about 20 minutes. But it's interesting that the Fed didn't buy the long bond today, but they're just pulling so much supply off that's helping the entire curve. So they bought it up, sellers came in, and then buyers brought it up, sellers tried it again, come back down to support. So resistance, what was resistance, this dotted purple line, let's zoom out. So this dotted purple line, this top one, has been resistance, is now trying to act like support. And then sellers finally cracked through, and then out of nowhere, this thing just takes off. There's no news on why, and then all of a sudden news that Democrats and Republicans are meet on Saturday to try to work through a deal. It caused bond prices to fall, but the market wasn't convinced. And the rest of the day was kind of like that. But now we're setting up for a massive move higher in bond prices, because look, what is left for them to break through? You've got these people that were selling here right at the top of this descending triangle, and then all these people up here that sold. And the question is what's really left? And not much. And that's why that auction schedule is pretty interesting coming into next week, because the Fed's going to continue to push this up. Now, there's a lot of talk that post-Labor Day, there's going to be an increased amount of debt issuance, and that has to cause yields to go up, as if it has yet. But don't worry, the Fed's still there. The banks are still buying. I don't suspect that will make any major difference, because it hasn't yet. And I'm not saying that because it hasn't yet. I'm saying more government debt does not lead to higher interest rates. It's very clear it leads to lower interest rates. So bring on the new issuance. There's no doubt the Fed will mop that up at some point too. But the chart from a technical pattern is telling you TLT is about to go straight up. And what will be interesting to me is if we see a lot of these Robinhood investors buy TLT at a 0% yield. Yeah, I'll be selling then. But I'll be very interesting to see it. So the dollar finally found buyers. I said it eventually would, and it got right back up into this supply zone after it broke through that. Let's go back. Let's zoom out to the 10-year weekly chart, and you can see it broke through this supply zone where buyers have been, but it's broken through that before where it's found buyers at, in the weekly charts, and sure enough, it did today. It's right in the supply zone. Remember, we looked at this chart recently of TLT overlaid with the dollar. And when the jaws are spread apart, only one's going to be right. My guess is TLT is right based on all the data and all the research I've done, which should indicate the dollar is going to head higher at some point. So let's talk about what's coming up next week. There is going to be a slight scheduling change. There will not be a video on Monday unless something very, very interesting happens for me to do that, because I have an interview scheduled that afternoon with Martin North to go back on Walk the World. So I want to thank all Martin North fans for being with us on the show. And I don't know if it's going to be published later that day or the following day, but I want to make sure that I'm in good shape, because there's a little crossover in my time of when I'm going to be interviewed by him and this show here. So unless something really interesting comes up, there won't be a show on Monday. Now, was I serious about actually potentially canceling the show after my thesis played out? And actually I am. So on this show, we've talked macro, we've talked relationship stuff. Now we're going to talk business. So when you have a business, a lot of small business owners, they have a good idea and they go out and they're making some money. And then what do? They have more good ideas. So they start, splitting their time apart, running these new ideas. The challenge is they never actually go back. And I shouldn't say never, but most of them never go back and do what's called spend time on your business. Not in your business. In is like, hey, I'm here at the office. I'm in my business right now. But how many business owners spend time on their business and actually look at, hey, I'm putting time on this project. So for me, creating videos, is it worth, in terms of what I get back, to continue doing them, or is it headed on a pace where I think that, yes, it's going to be something? So part of the issue coming up is, as my thesis plays out, there's going to be a period where I'm very busy taking care of stuff I've got to take care of for my clients. I'm already anticipating the number of videos are going to shrink. I mean, maybe we'll go to one a week if that's my time schedule, because of course, someone I think posted in the comments, well, what about your loyalty to your viewers? Well, the reality is my most loyal viewers are my clients. They need my attention. I have commitments to them. I'm going to be there for them to do what I need to do. And that doesn't mean making videos. If I have time, I will. If I don't, I won't. But what happens after that? Well, as I look at my business and look at the time I'm investing in the videos, I'm starting to ask myself, am I putting too much time in them, looking at, in terms of the viewership and where this channel is going, the show is going. And some of you said, hey, don't worry, when you're right, the channel will blow up. I don't know how that happens. Are people going to just show up here? I don't know how they're going to find out about it. But what I do know, and some of you have pointed out, is, hey, Steve, you need to get on other shows. You should try to get on this show or that show. And I really do appreciate that. The problem is I have things I got to do here. I've got my business to run, my clients to take care of. I've got other projects I want to work on that I haven't been able to devote time to. I don't have time to go out and be my own PR person and go out and try to get on other shows. So as I look at the show in general, I'm just not sure how long it continues, if it's a direction I want to continue taking my business. I'm not planning on dropping my commitment to be a money manager, a financial planner for my clients, to do a YouTube show. I just thought this would be really cool if it turned into something great. If it didn't, it didn't. And I know many of you love it, and the show, and I love you, and I appreciate that. So here's what I'm looking for: a little help. If there's anyone out there that has any experience in public relations or production of shows, and you're willing to help me out, and I can't really pay you. Maybe I can send you some gift certificates, or if there's any merch or swag, I can send you some stuff. I don't have any now. I gave it all away. It would not be a paid position. at all. But if there's something you're interested, if you have the time that you'd be willing to invest in saying, hey, I'll help you contact shows, I know how to do this, or I have friends or family that have this expertise, I can contact them, learn how to do it, and I'm willing to help you, send me a message somehow, email, Facebook, LinkedIn. If that's something you're interested in doing to help the show grow because you want me to keep doing it, then I've got to make this thing be more than it is now. It just has to be that way. Just from a time perspective and business perspective, it just doesn't make sense for me to continue to do the 3 shows that I'm doing now that are 30 to 40 minutes long. It just doesn't make sense to do it at that level. So if you want to help out, let me know, and maybe we can work together, and like I said, somehow, some way we'll find a way to compensate you, like I said, gift you a swag, maybe just notoriety of being that person to help the show grow. So if that's interest to you, let me know. Otherwise, I will see you on Wednesday unless something interesting on Monday comes up, and we'll get caught up then. I'm Steve Van Metre. Thanks for watching. Hope you have a great weekend. The content of this video is provides educational information only. Is not intended to provide investment or other advice. This video is not to be construed as a recognition or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity, and opinions expressed in this video that I'm own do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.